Today, we are diving deep into one of the most famous patterns in all of trading, the cup and handle. Now, you've probably seen it, you've heard of it, but it's also one of the most misunderstood and, frankly, misplayed patterns out there. So, by the end of this quick explainer, you're going to have a pro's playbook to spot the difference between a real opportunity and just another costly trap. Let's get right into it. So, why all the hype? Well, this is why. The legendary trader William O'Neill, he literally wrote the book on this stuff, and he identified this exact formation as the launchpad for some of the biggest stock moves in history. We're not talking about small gains here. We're talking about those explosive 200% plus runs that can completely change the game for your portfolio. Which brings us to the big question, right? If this thing is so powerful, why does it feel like a money pit for so many traders? Well, the answer isn't that the pattern is broken. It's that most people are missing the handful of crucial details that separate a high-probability professional setup from a complete amateur mistake. All right, first things first, we have to talk about the anatomy of a real high-probability setup. The single most common mistake happens right at the beginning, just completely misidentifying the pattern's shape. What looks like a cup and handle to the untrained eye often looks like a clear stay-away signal to a pro. Let's break down what they see. Okay, take a look at this. This is a picture-perfect textbook example. The very first thing a professional trader looks for is the shape of that cup. See how it has that smooth, rounded bottom? It looks like a bowl or a teacup. That U shape, that's not a suggestion. It is absolutely non-negotiable. It represents a nice, orderly period of consolidation, not some frantic, sharp rebound. And let's be absolutely crystal clear about this. A U-shape tells a story. It's a story of sellers slowly running out of gas and buyers gradually and, more importantly, stably taking control. That's called accumulation. A sharp V-shape? That's just a volatile, knee-jerk panic bounce. It's chaos, not control, and it almost always fails just as fast as it appeared. And here's another place people get tripped up. The cup and handle is a bullish continuation pattern. What does that mean? It means it should show up after an already existing uptrend. It's signaling a brief pause before the next big move up. Patterns like rounding bottoms or double bottoms, they look kind of similar, but they're reversal patterns. They show up at the end of a downtrend. So, you see, context is everything. So, here it is. This is the cheat sheet the pros use. And these aren't just loose guidelines. They are strict, hard and fast rules. The pattern needs time to develop, at least 7 weeks. The cup itself can't be too deep. If it drops more than about 35%, there's probably too much damage to the stock. And the handle, this is a big one. It has to form in the top half of the cup and slope down just a little bit. That's the final shakeout of nervous investors. Okay, on to our second section, the secret of volume. So if you've validated the shape, you're halfway there. But the real secret ingredient, the piece of the puzzle that almost every amateur ignores, is volume. Think of it like this. Price tells you what is happening, but volume tells you the story behind what's happening. It shows you the conviction. And this tells that story perfectly. As the price drifts down to form the bottom of that cup, you want to see volume just dry up. That's the selling pressure completely exhausting itself. Then, as the handle forms, volume should be super light. That's the quiet before the storm. And then, bam, on the breakout day, volume should explode. That is the market shouting, loud and clear, that the buyers are back in control and they mean business. And listen, we're not talking about just a little bump in volume. For a breakout to be considered valid and have real conviction behind it, you need to see a massive surge. We're talking at least 40 to 50% above the average daily volume. If you don't see that huge spike in activity, that's a major red flag. No volume means no conviction, and for a pro, that means no trade. Simple as that. All right, section 3 is all about timing the perfect entry. So you've done your homework. You found a textbook shape. You've got a beautiful volume signature. Now comes the moment of truth, actually putting your money on the line. And I'm telling you, jumping in too early is probably the easiest way to turn a potential monster win into a super frustrating loss. So let's be really clear about what a real breakout looks like versus a false one, what traders call a bull trap. A real breakout isn't just a quick little peak above the handle's resistance. No, it's a strong, decisive close above that level, and it has to be on that huge volume surge we just talked about. The false breakout, it's the opposite. It spikes up on weak volume and then gets slammed right back down, trapping every single person who got impatient and jumped the gun. Patience is your best friend here. Okay, so you're in. The trade is working. Now what? you need a logical plan for taking profits. The standard way to do this is pretty simple. You measure the depth of the cup, right from its lowest point up to the breakout level. Then you just take that same measurement and add it on top of the breakout point. This gives you a calculated price target, so you're not just guessing when to get out. Let's move on to Section 4, Smart Risk Management. We've been talking a lot about offense, about making money. But professional trading, at its core, it's all about defense. It's about protecting your capital. You can't win if you get knocked out of the game, right? And that means managing your risk on every single trade, no exceptions. I love this quote because it gets to the absolute heart of what a stop loss is for. It's not just some random price where you decide you've lost enough money. No, it is the exact point on the chart where the market is literally telling you, hey, your entire idea for this trade was wrong. So where do you put that safety net? Well, the logical place is just below the lowest point of the handle. But here's a pro tip. Don't put it right at the low. Give it a little bit of breathing room to account for the market's natural noise and volatility. And try to avoid obvious levels like big round numbers, because those are often magnets for stop hunts. You have to be strategic with your defense. And finally, Section 5. This might be the most important rule of all, respecting the broader trend. We need to zoom out for a second, because no chart pattern, no matter how perfect it looks on its own, exists in a vacuum. The single biggest factor that determines if a bullish pattern like this will work is the health of the overall stock market. And this chart really makes it simple. In a strong bull market, a beautiful cup and handle setup is like putting a speedboat in a powerful current. It's got a super high chance of success. But trying to trade that same pattern in a nasty bear market, you're basically trying to sail that speedboat straight into a hurricane. The odds are just completely stacked against you. You have to trade with the wind at your back. And here's another key insight that can really improve your odds. The data is pretty clear that the cup and handle's reliability actually goes up on higher time frames, like weekly or even monthly charts. Why? Because those longer-term charts filter out all the random day-to-day noise, and they show you the true, powerful underlying trend. That leads to much, much higher success rates. Okay, wow, we have covered a ton of ground. We've dissected the pattern's anatomy, we've decoded the secret language of volume, we've figured out how to time the entry, manage our risk, and of course, respect the overall market. So let's bring it all home and wrap this up with a final recap of the pros playbook. So here it is, your 5-point playbook. Number 1, validate the shape. Is it a perfect U? Number 2, confirm it with that big volume surge. Number 3, wait for a decisive close, don't jump the gun. 4, set a smart stop loss. And number 5, and this is the big one, always check the overall market trend. This discipline, right here on this screen, is what separates consistent winners from the rest of the crowd. And hey, if you need any more motivation to be disciplined and follow these rules, just look at this number. When all the stars align, you get the perfect pattern, the right volume, and a strong bull market, the success rate can be just absolutely astonishingly high. It's not about finding just any pattern. It's about having the patience to wait for that A-plus home run setup. So there you have it. You now have the playbook that separates the pros from the amateurs. Remember, the pattern you see on a screen is just a shape. The real edge comes from understanding the psychology behind it, following a strict set of rules, and having a disciplined plan. The next time you see one of these forming, you'll know exactly what to look for.